You probably believe that a perfect trading setup guarantees you are going to make money. It is a very common assumption. You think that if a chart aligns perfectly with everything you read on a random internet forum, the universe owes you a profit. You think your main job is to find trades, click a button, and collect your reward for being so clever. That is not your job. Your job is to wait. You are sitting inside a digital casino that is running 24 hours a day, specifically engineered to flash bright lights, paint beautiful patterns, and induce absolute panic. The market is designed by people with supercomputers and math degrees to transfer wealth from the impatient to the patient. You are a completely rational person. You are simply trying to make a better life for yourself, using the tools you were given. But you are operating inside a culturally overwhelming system that demands constant action. You are told that if you are not trading, you are not working. That is a lie. 90% of the setups you see on your chart are garbage. They are low probability traps. They are carefully laid illusions meant to make you hand over your capital. Profitability is not created the moment you click buy. Profitability is manufactured in the ruthless, cold, and systematic filtering process you apply before you ever touch your mouse. You are not a trader. You are a strict bouncer at the door of a very exclusive club, and your money is the VIP. Most ideas should not get past the velvet rope. Today, we are going to build your velvet rope. We are going to walk through the exact filtering system you need to stop trading trash, perfectly size your risk, and survive the 10% of setups that actually give you a statistical edge. I know this because I used to be a data analyst for a prop firm. I had unrestricted access to the back-end servers. I did not look at charts. I looked at the raw data of thousands of funded traders to find the exact mathematical difference between the 1% who take massive payouts and the 99% who burn their accounts to the ground. I took that classified data and put it into a book. It strips away the guessing. It shows you the actual server data. You get the exact win rates, the risk-to-reward ratios, the daily loss limits, and the exact trading frequency of the top 4,000 traders. It gives you strict, mechanical rules to physically force patience and choke out your urge to overtrade. It is a step-by-step survival guide to mechanize your mind. The link to grab your copy is in the description. Get the math on your side. We begin with the evidence. Most people enter a trade based on a single piece of information. They see a little line cross another little line at the bottom of their screen. They see an indicator like the RSI dip below a specific number, or they draw a diagonal line across 2 points on a chart, watch the price touch it, and assume the market will respect their artwork. This happens because you are desperate for action. You stare at a screen for hours. Your brain craves the dopamine of financial risk, and you treat a single mathematical squiggle as a divine command to risk your hard-earned money. It is not your fault. You were sold a system by internet gurus who pretend trading is as simple as matching colors. You were handed a plastic spoon and told to go dig for gold in a concrete floor. You must demand a minimum of 3 confluences before you ever take a trade. A single indicator is never a setup, it is a weak suggestion. Overlapping evidence is the only way to build a case that survives the chaos of the market. You need a structural break in the trend. You need price to reach a major zone of supply or demand. You need an optimal Fibonacci level lining up perfectly with that zone. You need 3 distinct logical reasons that all point in the exact same direction. If you only have 1 reason to enter, the setup is trash. If you only have 2 reasons, the setup is suspicious. You gather your 3 pieces of structural evidence, you build a fortress of probability, and you wait for the market to come to you. Demand actual evidence. But even when you find that evidence, you have to survive the most dangerous myth in the entire trading industry. The myth is certainty. People believe that if a setup meets every single rule in their strategy, if it has 3 confluences, if it looks exactly like the textbook, it is a 100% sure thing. They believe a perfect setup cannot fail. Any trade can fail. The market does not care about your perfectly drawn triangle. It does not care about your hopes, your bills, or your strict adherence to a strategy. Institutional order flow can completely invalidate the best retail setup in seconds, because a bank on the other side of the world decided to liquidate $1 billion. The market is ruled entirely by probabilities. Certainty does not exist here. So what does it mean to have a 100% perfect setup? Before you enter, you must grade your trade on a scale of 1 to 100. Grading a setup at 100% does not mean the trade is guaranteed to win. It simply means the setup meets all your criteria perfectly, which gives you permission to allocate your full, standard risk. If your rule is to risk 1% of your account on a trade, 100% setup means you are allowed to risk that full 1%. But what if the setup is a little messy? What if it has your three confluences, but the trend on a higher time frame is fighting you? That is a 60% setup. You do not necessarily have to skip it. You just change the math. You drop your risk. You risk 0.5%. You risk 0.25%. Probability dictates your risk sizing, not your emotions. You scale your exposure based on the quality of the evidence, accepting that even the most beautiful chart pattern can turn into a burning wreckage in an instant. Math does not care. This brings us to the math you are probably forcing onto the market right now. Every trading book, every course, and every loud voice on social media repeats the exact same rule. They tell you to never take a trade unless you have a 1-to-3 risk-to-reward ratio. If you risk $100, you must make $300. It sounds incredibly disciplined. It sounds like a rule created by very smart people in expensive suits. The reality is that the market is a dynamic, breathing entity, and it refuses to conform to rigid textbook math. Often, the logical structure of a chart only offers a 1 to 1.5 reward. The next major level of resistance, the place where price is highly likely to reverse, is sitting right there. But because you are trying to be a good, disciplined student, you ignore the chart. You place your take-profit target way past that logical level, just to satisfy your arbitrary rule of 1 to 3. You watch the trade go into deep profit. You watch the green numbers swell. You watch the price hit the exact structural level it was always going to hit, and then you watch it completely reverse. You sit there, frozen, as the green turns to red, as hope turns to a cold nausea in your stomach, and your disciplined trade hits your stop loss. Trying to squeeze perfect math out of a chart that does not support it turns winning trades into losers. Take what the market gives you. You must adjust your reward expectations based on what the specific setup dictates, not what a textbook told you. A high probability trade that gives you a 1 to 1.5 return will grow your account steadily over time. A forced 1 to 3 trade that ignores market structure will just slowly bleed you to death through 1,000 tiny cuts. Do not force math on the market. And speaking of tiny cuts, we have to talk about the most infuriating experience in trading. You do the work. You find the confluences. You enter the trade. The price immediately spikes, taps your stop loss by a single fraction of a cent, kicks you out of the trade, and then flies aggressively in the exact direction you predicted. It feels deeply personal. It feels like a very specific algorithm looked at your tiny account, laughed, reached out, tapped your shoulder, and then handed out money to everyone else in the room. It is not personal. It is just liquidity. The deeper problem is that your trades are suffocating. You are not giving the market enough room to naturally fluctuate. The root cause of this pain is entirely your fault, but again, it comes from a place of trying to be responsible. You look at your account, you decide you only want to lose $50, and you calculate exactly where your stop loss needs to be to only lose $50. You are placing your stop loss based on your wallet. You should be placing your stop loss based on the chart. Your stop loss must go at the exact structural point where your entire trade idea is proven completely wrong. If you buy at support, your stop loss belongs safely below that support, out of reach of the sudden violent wicks that institutions use to hunt retail panic. The market needs to inhale and exhale. It needs to gather the liquidity of 1 million panicking retail traders before it can make a real move. Give it some room. If placing your stop loss in a structurally safe place makes you risk too much money, the solution is not to tighten the stop loss. The solution is to reduce your lot size. Practicing the art of reducing your position size is the ultimate shield. A smaller lot size allows you to use a wider, safer stop loss without ever increasing your overall dollar risk. You can put your stop loss out of harm's way, give the trade room to breathe, survive the violent wicks, and still only lose your standard 1% if the idea is completely wrong. Position sizing is how you survive the chop. But even if you master the confluences, grade the probability, accept the realistic math, and give your trades breathing room, you can still destroy your account in a single afternoon. You can do this by falling victim to the boredom trade. You take a trade that looks just good enough. It does not really meet your criteria, but it is close. It immediately reverses, and you take a painful, unnecessary loss. You sit back in your chair, you blame your strategy, you blame the broker, you blame macroeconomic data you do not even understand. The real reason you lost money is because you were watching a chart for 4 straight hours and you were bored. Your brain is addicted to the casino. The screen is a slot machine. If you sit flat in cash for too long, you feel like you are failing. You feel the urge to do something, to prove you are a real trader. So, you start hallucinating setups. You lower your standards. You convince yourself that a terrible trade is actually a genius contrarian play. Trading because you are bored is a very confident mistake. Before you ever click a button, you have to perform a final psychological audit. Ask yourself a simple question. Am I taking this setup because it actually passes my strict filtering system, or am I trading because I want to feel something? Am I trying to revenge trade a loss from this morning? Am I afraid of missing out on a move everyone on social media is talking about? If you cannot confidently say that your trade is born purely from cold, unfeeling logic, you must walk away from the computer. You do not need another magic indicator. You need forced discipline. You need a digital bouncer to protect you from your own terrible decisions. That is exactly what the Alpha Equity Manager does. It has a feature called the Hard Equity Shield. If you tell the software your maximum daily loss is 2% and your floating loss hits exactly -2%, the system takes over. It instantly closes every single open position you have. Then it completely disables your buy and sell buttons for the rest of the day. You are physically locked out of the casino. And because human beings are weak, you might try to go into the settings and change that limit to 3%, just to take one more revenge trade. You cannot. The time-locked vault instantly rejects your emotional input and snaps your settings back to your original rules. You cannot cheat the system. It even includes a pre-trade calculator that shows your exact dollar risk before you enter, so you can never lie to yourself again. The link to download the Alpha Equity Manager is in the description. Secure your account. Stop trusting your emotions. To be a highly active, profitable trader, you have to accept a few truths that feel completely backward. First, cash is an active position. Holding your money and doing absolutely nothing is a highly profitable strategy. Sitting flat during choppy, ugly market conditions means you are mathematically outperforming the millions of people who are bleeding their accounts dry through forced, mediocre trades. Doing nothing is doing something. Second, the perfect setup is usually terrifying. The highly probable, beautiful setups rarely feel good to execute. They feel uncomfortable. They require you to buy when the retail crowd is panicking, and they require you to sell when everyone else is euphoric and greedy. If a trade feels incredibly easy, comfortable, and obvious to the entire internet, it is almost certainly a trap. Good trades feel bad. Finally, strict mechanization will ruin you. If you blindly force rigid rules onto a wildly flexible market, the market will break your rules and your account. Amateurs trade for the thrill of the dopamine hit. They trade to feel smart. Professionals trade strictly for the math, and they spend most of their time doing absolutely nothing. Stop spraying capital into the dark hoping to hit a target. Protect your money, demand your 3 confluences, grade your probability, size your risk perfectly to give your trade room to breathe, filter out the noise, become comfortable with the boredom. The market will always offer you trash, you just have to stop buying it.